If I look at other commodities such as gold, if the value for investors is usually sort of late exploration development stage. That's when you get taken out. Once you move into production, it's there's less returns for the shareholders in terms of share appreciation, etc. How do you value this space? Obviously, you've got gold, you've got nickel. There's this curve building of value creation. You've got existing shareholders, you've got potential new shareholders, and you're constantly evaluating where the company is today and where the maximum point of return is. I mean, how do you go about that?
I think, again, you pointed out that we've had this massive run since the fall. We're up 4x plus since that time frame, and people think, oh, well, I've missed the boat. But today, at a $220 million market cap, again, at Beta Hunt, the infrastructure that we acquired that would cost you $400 million to replace today. So, if we find any resource, the investor's getting it for zero. And again, given the scale of the shears and the highlighted potential already from the historic drilling that's there, this could be a very large, multi-million ounce deposit potentially at some point in time. And so, if you look at what those kind of resources and hopefully reserves in the not too distant future, trade at, exit at multiple wise, again, that can be a very, very valuable asset on its own. And then on the Dumont side, again, we haven't been in a development cycle for a long time. So I think people have forgotten about what, metrics around what development assets, basically exit for. And again, there's been a few recent examples. So, Arizona Mining with their zinc project in the Southwest United States. If you look at the takeover of Nevsun, those basically both went out for close to 1x NAV. And if you look historically, high quality base metal assets, of the scale that Dumont and these assets are, exit at 0.8 to 1x NAV. And if you look at what our old feasibility study said, we had a $1+ billion NAV. The new feasibility study is going to probably come in. The capex is going to be lower and the NAV is going to be lower, but it's going to be in the same order of magnitude. And so, again, we think there's tremendous value upside, on both those assets from where we're sitting today.
Okay, well, that'll be interesting to kind of get your guidance on that as you move through that process with both assets. As you say, they're both world-class assets. I imagine you're on quite a few people's radar. It's a question of, I guess, when you want to have conversations and what those conversations, mean in terms of value. Can I come back to Beta Hunt just momentarily, if I may, and then if we can talk about Higginsville. So Beta Hunt, you've obviously got the farthest day vein. You extracted several very large, high-grade rocks, which you have been on tour with. I've seen them live myself here in London. Very, very impressive. But I guess you've extracted the sort of, or have you extracted the maximum PR value from those now? Are those things which are now going to be monetized?
We did, take them around the world because, again, to be able to generate that amount of PR and exposure, is, again, companies don't get that kind of opportunity every day. And so, when you're the feature Korshak exhibit at the BMO Mining Conference, which is the first time that we've been invited, and you've got people who've run, I won't name specific names, but, guys who ran, some of the largest mining companies in the world crouching behind one of your giant rocks, taking a selfie with it, to be able to have 15 minutes of discussion time with them, that's, those are invaluable. And again, that's been repeated time and time again with, a number of the larger mid-tier gold producers, a number of the largest mining companies in the world. So, it's tremendous exposure for the asset.
No, it's very interesting to see. I think people become quite childish when they sort of see those rocks. They behave in a very different way. But let's talk about Beta Hunt. So, Goldfields and St. Ives. Are you in any discussions with them?
So the asset had some option potential for some of the adjacent ground underground. Mm-hmm. Again, at the right time, we'll re-engage with Goldfields to see if there's any interest there. Fundamentally, we have this ramp that goes down into the heart of that system. And so, there are areas, adjacent to the property that would make sense to access from that ramp. So, at the right time, we'll resurrect those conversations with Goldfields and hopefully, come to a deal that makes sense for both groups.
Right, and obviously with Higginsville, with the St. Ives operation as well, is that on the table? Is that part of the thinking?
Oh, in terms of with Higginsville, just have a, again, from a having a mine mill combined is a much more attractive, acquisition target, and the reality is, unlike the North American market, unfortunately, where the mid-tier gold guys have been, have struggled for, quite a while, the Aussie market, you've got a bunch of mid-tiers that are fully cashed up, have, paper that's, very well valued. So again, I think, once, we get through these next few rounds of drilling here and really start to prove up the scale of resource that we think we have, we're going to get more than a few knocks on the door from these mid-tiers who bought a bunch of old gold mines and that are, facing production profile issues. Whereas we bought an old nickel mine that happened to have a brand new gold deposit underneath it.
Yeah. So let's get on to Higginsville, because I think everyone wants to understand your thinking, the process, why you structured it the way that you have. So why don't you give us the run through, and I'll perhaps pick up on some of the questions.
Yeah, so we're picking up Higginsville for $50 million, half 50 million Australian, half in cash and half in shares that Westgold will have to hold on to for a period of time. When we announced that we had the option, we did the equity, what we believe will be the equity component that we need to satisfy that $25 million payment. And, we've gotten very attractive terms on a bunch of very non-dilutive type financings, that we expect to have in place by the time we're ready to close the deal in early June. Again, fundamentally, when we bought Beta Hunt, the plan was, start drilling it, get a long-term milling solution in place, and at the right time as well, we'll be talking to the royalty company about reworking the royalty so that we get to a number that makes sense, hopefully for both of us. And so, when the Higginsville opportunity came around, there's only so many mills that are already in place, that close by, and so. Again, to build that size mill new today would probably cost you close to $100 million. So, a $50 million price tag, was much better than buying it new. And then in addition to the mill, we get a significant land package on one of the most prolific gold camps. Yeah. And so, any of the resource value and the operations which will be coming online later this year from Baloo and so forth, that's nice. Easy to process, good grade for an open pit, oxide ore, and so that blended with the material from Beta Hunt makes a lot of sense. We save $15 a ton versus what we're paying at Beta Hunt right now, so it doesn't take too many years of just the milling synergies alone to pay for the acquisition. Never mind.
So tell me about the numbers there. So it's $50 million. Yeah. You've obviously done the math, worked out that that's good value. Yeah. You're saving $15, which is great. But can you tell us a bit more around the thinking of the way that you've structured it in terms of the cash and the shares? Obviously, with the share price as it is now, it's a little bit lower than it was, just after Christmas. Do you look at it as a case of, money's the cheapest when you can get it? I mean, do the deal now. Could you have waited?
No, but I think if we had waited to do we did the equity component. When we announced it, because again, we wanted to take away sort of any sort of equity overhang that's there. I think when we announced that, and again, hopefully we're in a place where it is completely non-dilutive financing, that I think that will, really help the story going forward. In terms of doing the deal when we did it, obviously you'd always, there's the best time to do it, and then there's the time when the asset's available. So, the asset was available. It was the right, it was the right time to do it, and we chose a structure that we think made the most sense for both investors, and we're glad to have Westgold as a large RNC shareholder here going forward.
Right.
And Peter Cook quite likes the Beta Hunt mine.
So how quickly does something like that pay for itself? I mean, $50 million is a lot of money, right? So
yeah, if you just look at the milling synergies alone, if you just assume, Beta Hunt's going to produce 2,000 tons a day, just the milling cost savings versus tolling, you're looking at $10 million a year. So if we do nothing else other than get milling cost synergies, then it's, paid for itself, in just over 5 years. If you, and again, at a higher mill rate, that cycle, comes in, much shorter. But then on top of it, again, we have, all of that resource that's there. We will have ounces coming from that land package. And then being positioned in that part of the camp opens up a bunch of other future opportunities, going forward.